Here we go, you guys. So we're going over the basics of trading XAU versus the USD. And my name is the Beach Trader, and I live a freedom lifestyle, financial freedom, time freedom, and spiritual freedom, which is the most important, to have a positive attitude and a growth mindset and to win in life. So let's go straight into this, man. This stuff is really amazing. I love gold. You guys know that our number one thing that we trade on the live freedom stream right now is gold. I also trade mostly gold, Bitcoin, and then Forex, the US 30 and the global 100. So let's go over the basics of trading gold. Number one is you're going to learn about the short history of gold. You always need to know about the history, understanding the most traded gold pair. What does XAU USD represent? And then number two part of it, we're going to go the importance of gold in the world markets. What moves the price of gold? How central banks influence the price of gold? How trends in the USD affect the price of gold? How inflation dynamics affect the price of gold? Why trade XAU versus USD? Which market session is the best time to trade XAU and USD? 4 ways to trade the gold, and then how to check the commodity strength of XAU and USD. And I'm going to give you guys a simplified analysis by targeting previous highs and lows. And I want you guys to really zero in on this. You might need to take some notes because this is going to be a serious training. It will be in the back office also. So short history of gold looks like this. Over 4,000 BC, that would be 6,000 years ago. It was mostly used for jewelry around the world. And then 3,000 BC, evidence of mankind ornamental use of gold. Then 2000 BC, Egyptians are the first gold miners. 1500 BC, gold first used as money. This is the first time gold was used as money. 1000 BC, squares of gold are legalized in China as a form of money. 0 AD, and it's so funny because our whole history is based on Jesus Christ, his birth and his death. So AD means after his death of Jesus. And so the time's going to go up from there. And so 1300, 1000 AD, 1300 AD, the first hall markings practice established. 2000 AD, US defaults on gold-backed dollars. That happened about 33 or something like that. That's when they got off the gold standard. Gold hits an all-time high in 2020. That's when it hit its all-time high. And so let's go over this. History of gold as a commodity. The first thing is with gold, you're going to talk about Africa, right? Gold was generally used for a couple thousands of years, slowly create things such as jewelry and idols for worship. So jewelries and idols was one of the main things. And if you read the Bible or you read ancient books, it always talks about people making idols out of gold. This was until around 15 BC when the ancient empire Egypt, which benefited greatly from its gold-bearing region, Nubia, made gold the first official medium of exchange for international trade. And as we know, if we're a history person like me, I used to teach history, we know that Egypt is in Africa. If that's a shocking thing to everybody, that's something that you're going to learn today. So this is Africa right here, and this is Egypt in this area right here. Nubia is a little bit beneath Egypt, and it was actually a part of Egypt, and that would be the lower parts of Africa. And Egypt at this time expanded through Israel, went up to Iran, and went up to, the Middle East also, what you would call Saudi Arabia and different things like that we know now, Iraq and things like that. So they made gold the first official medium of exchange for international trade. And then the slave trade. This is where a lot of African Americans basically got over to America. In the transatlantic slave trade area, Europeans identified the region as a Gold Coast because of the large supplies of and market for gold that existed. So this is the Gold Coast right here. This part, Ghana, Nigeria, Benin, even Morocco up at the top of Africa. And so this is called the Gold Coast. This is where most people were taken as slaves and brought over to America with this arrow right here, okay? Portuguese traders built the fort of Elimina in 1482 within 10 years of their arrival on the coast. So right here is Portugal. And so they came down here and started mining gold, started getting gold from the locals. The locals had the use for gold, but it really wasn't that valuable to them. Like they wouldn't lose their life for it. You know, in gold in other places of the world at this time, it was worth more than somebody's life. And that just makes sense if you understood it. Let's talk about the gold standard. The gold standard is really what got into this to where, you know, gold became so important, where, you know, money was basically based on gold. So the process of colonization and globalization of other parts of the world by the developed world made new discoveries of gold commonplace. And with that came a great influx of supply of the metal, meaning that the gold standard was able to flourish. In 1871, a new international gold standard began when England and Germany officially adopted the gold standard. And by 1900, most developed nations have followed suit. So they started saying whatever money that we print is backed by gold in like a vault. So if you think about it, everything that had to do with money would have to be backed by a piece of gold somewhere in their government. The period from 1871 to 1914 was a fairly stable period in the world politically, which enabled governments to work very well with each other in establishing a stable gold standard. It was the golden age of the gold standard, if you will, but it all came crashing down starting with World War I in 1914. And so the gold standard, you could take a piece of gold and go around the world and get, you know, the worth of what gold is. Now, you know, the number one probably thing in the world with money is the $100 bill, the American $100 bill. And that's basically the new gold standard around the world. If you got a $100 bill, it's the most spent bill in the whole world is the $100 bill. And people take that around different countries. They make big purchases, governments, and buying things that usually, if they're using cash, are using $100 bills. And so, you know, America defaulted around the 1930s on their gold standard, and the wall came crashing down on us. And now basically our economy has been making money from air. So there's nothing to back our money. And that's why inflation goes up so fast right now, because our money isn't worth anything. You know, when I was a kid, I'm 43 years old. I just turned 43. So when I was 18 years old, the minimum wage in San Diego was $5, right? And now the minimum wage in San Diego is over $15. So just in, you know, a little bit over 20 years, the money has basically tripled its value. If you just look at the average person getting wages, which is, man, crazy. And that's why stuff is so high right now. All right. Gold has been considered a highly valuable commodity for millennia, and the gold price is widely followed in financial markets around the world, most commonly quoted in the US dollar, XAU, and USD. Gold price tends to increase as stocks and bonds decline. The metal holds its value well, making a reliable safe haven. So this is a safe haven, and people love it. So when things get really high or things get really low, this gold stabilizes that. Gold is a valuable commodity. XAU USD. So gold versus the USD is called XAU USD. It represents the price of 1 troy ounce of gold in US dollars. In other words, it tells you how many US dollars you could need to buy 1 troy ounce of gold. Over the years, gold has remained an attractive commodity due to its store value, beautiful appearance, and malleability. The chemical symbol for gold is what? XAU. So that's why it's XAU versus USD. Some of you guys probably didn't know that, but the chemical symbol for gold is XAU. So it's used for the form XAU versus the USD. This means that when going long, when you're buying on gold, CFDs, and we'll talk about CFDs in a second, a trader is simultaneously buying gold while selling the dollar. So when you buy the gold, you're selling the dollar. Conversely, when going short, when you're selling gold, they are selling gold and buying the USD. So the world market in gold, this is That was like a little brief history of gold and what it really means. But this is more in depth of why we trade gold and what does it mean to trade gold, right? So this is what gold really is. Gold, why is it important? Well, speculation. If you look at this pyramid right here, there's options, futures, and spread betting at the top. That's the least, right? And then you get into the growth part, small cap stocks, large cap stocks, equity, mutual funds. Then you get into income, blue chip stocks, a commercial and residential property, that's real estate, corporate and government bonds. And then you get into the security of gold, cash deposits, money market funds, annuities, T-bills. And then you get all the way to the bottom to where all this foundation is from gold bullion that's stored in our government facilities. So what moves the price of gold? Good question. Upward or downward movement. Now let's take a look at what moves the price of gold in the market. Like any other instrument, supply and demand are the main factors that push the price of gold up or down. In times of recession and high tension in the geopolitical environment, we notice that gold rallies. So right now we're in inflation, gold is building up. As previously mentioned, gold is considered to be a safe haven metal. In such instances, investors rush to trade gold in order to avoid losses in the stock markets. However, this is not the only case where we notice a high demand for gold. We also notice a price appreciation in booming periods. People have the capacity and, more importantly, the money to trade gold, whether that's for investment or leisure. In times like these, we find the desire to invest in gold and even learn how to trade gold, including the trading of gold itself, spikes significantly. So how central banks influence the price of gold. This is like a central bank right now, right there on the bottom right. And this is how they got their gold. And that's called gold bullion. They're big bars of gold that sit around in facilities, right? So all central banks own gold, all of them. This is due to gold's historical association with banknotes and coins. In the past, a coin or banknote could be redeemed in exchange for gold. Let's take the Bank of England, for example. They hold around 400,000 bars of gold. This is worth over 200 billion euros. The Bank of England's gold reserve, gold bullion source, and that's where we got that information. These days, the gold reserve is justified by the fact that the value of gold behaves differently than the foreign currency reserve. So we have, when companies topple, like when Iraq got taken over, people went into their gold, their banks with their gold and just started stealing their gold. And when it happened in the Philippines. It happens when any country gets overtaken and ran over really quick. These are the things that happen. Supposedly in America, one of the biggest storage of gold was underneath the buildings, the trade center buildings. And when those planes hit, nobody knows where that gold went. Nobody knows where all that gold went. But well, who knows? It didn't just melt, right? So how central banks influence the price of gold. Gold is held by reserve managers for diversification purposes, since both the value of gold and foreign currency reserves are more stable together than the value of gold reserves and foreign currency reserves are separate. Gold can also be used to fund emergency liquidity assistance or foreign exchange interventions, among other things. Furthermore, central banks pay particular attention to general economic conditions when describing how to trade gold in their possession. This means that central banks have enormous pricing power in gold, which could be potentially dangerous to other market participants and the gold producers. We will show you how you can get signals for this later in this guide. And this is what usually happens. What usually happens is there's big people with gold and they'll sell or they'll move their gold here and there. And then the price will topple like $10 or the price will go up. Basically, people right now can manipulate gold. People can manipulate Bitcoin. You know, the dollar is very hard to manipulate because there's so much money in it, but it's very simple for, you know, a couple billionaires to come together and start manipulating gold if they have enough in their family portfolio. There's big wealthy families that have gold that move it around and can shake the price up $5, $10. And if you know that's going to happen and you can trade that amount on the CFDs, you can get rich overnight. Collectively, at the end of 2014, central banks held around 30,900 tonnage of gold, approximately 20% of all the gold ever mined. These holdings are highly concentrated in the advanced economies of Western Europe and North America, a legacy of the days of the gold standard. So 20% of all gold is basically, in, the banks, the central banks. So all the gold that you see people wearing like Mr. T and other people like that, that isn't, it's about 80% of all the gold in the world is that. But 20% is just accumulated by the rich and governments. How trends in the USD affect the price of gold. So when learning how to trade gold, you need to understand how gold is priced and how the USD influences this. So since gold is quoted in USD ounce, it should be logical that dollar strengths or weaknesses will affect gold prices in particular. So gold prices tend to increase when the USD gets sold. That is because in relative terms, gold becomes more expensive. Gold prices tend to decrease when the US gets bought. That is because in relative terms, gold becomes cheaper. So the way to understand the currency strength, usually when we're looking at Forex, we want to see currency strength. Well, you'll have to look at the dollar on currency strength. If the dollar is really strong, then gold is not going to be strong. If the dollar is really weak, then gold's going to be really strong. So it has an inverse relationship. We'll go over a little bit more about what that means. How inflation dynamics affect the price of gold. And this is so true to where we are right now in our world. But inflation describes a general increase in the price of goods and services. It's the reason why $100 USD bought more in the 1990s than today. Inflation erodes the value of savings over time and decreases the burden of debt to the borrower over time. This is a general reason for interest being applied in both cases. Lower unemployment or stronger economic activity is seen as a potential inflationary trigger. Some other triggers are increases in commodity prices or workers' wages. That's what we were just talking about. Changes in the consumer price index, that's the CPI. You guys can check that on the internet. I do that every day. Correlate directly to changes in the price of gold. Investors actively seek tangible goods as an asset to hedge with against inflation. Consequently, a consumer's desire to learn how to trade gold increases. There is also a psychological component to this behavior. Currencies, stocks, bonds, ETFs are all intangible assets of investment. They're all pieces of paper at the end of the day. So when the future outlook gets gloomy, investors tend to remember this fact and search for safety in hard assets, which are gold. And that is why hard assets such as oil, natural gas, silver, farmland, diamonds, and real estate all tend to be inversely correlated with the stocks and bonds. So how to check the commodity strength of XAU and USD. This is something that people have been asking me about, and we're going to go over that. And then through my research, I really found out some really amazing things that's going to help everybody trade better. So gold is usually denominated in US dollars. Therefore, there's a relationship between the price of gold and the dollar, in that there can be an effect on gold prices as the value of the dollar rises and falls. So the US dollar index, which is called DXY, that you could check, and gold is XAU versus the USD, are usually inversely correlated. That is, the two assets move in opposite directions. So if DXY is going up, the gold XAU USD is going down. If DXY is going down and losing strength, then gold is going up. And the thing that you need to know is how many times or percentages is that going to happen? Well, although XAU, USD, and DXY are not always negatively correlated to the same degree, so it's not always exact. They are negatively correlated most of the time, with the current correlation at 0.69. If one asset breaks and closes through its support or resistance level, the chances are nearly 70% that the other one will break through as well. So what does that mean? That means 75% of the time when the DXY goes up, gold goes down. 70% of the time when DXY goes down, gold goes up. But check this out. This is something that I really did my research. Odd versus the USD. Look at this. Gold has a positive correlation with odd USD. When gold goes up, odd USD goes up. When gold goes down, odd USD goes down. Historically, odd USD has had a whopping 80% correlation to the price of gold. So if you want to check the currency strength of gold, the best way to do it isn't to look at the dollar. It's good to look at the dollar, but the best way to do it is to look at odd USD. If odd USD is going up, then XAU USD will go up. If odd USD goes down, then XAU USD will go down 80% of the time. That's a whole 10% more correction rate than just looking at the dollar and gold alone. So why trade XAU USD? Let's go over why we trade it. These are the things why I trade. So XAU USD respects supply and demand levels very well and is therefore perfect to trade in combination with supply and demand zones. The reason people buy or sell gold, creating the demand and supply flow, can be pure speculation to acquire or distribute physical gold and as a hedge for commercial application. For day traders, the purpose of trading gold is to profit from its daily price movements. Gold trading can be profitable, though it requires time, patience, and attention to detail, the stuff that we teach you here. Many serious investors like to add it to their portfolios to hedge against more volatile assets like Bitcoin and some stocks. Just like Bitcoin, which has a limit, supply and demand impact gold prices. So when is the best time to trade gold? This is something that, we really need to know. And I looked it up and did a lot of research from the best traders that trade gold. And they say that the absolutely best time for gold trading is from 7 to 1700 GMT time. That's like a global time position. But when is that Pacific Standard Time? That's between 12 noon to 10 p.m. night time. So we're in the zone most of the time with our trading classes in that noon to 10 p.m. And then Eastern Standard Time, that would be 3 p.m. to 1 a.m. This is because the volatility is much higher and opportunities for making a profit are much more frequent with big market moves, especially in these 10 hours. So gold has a huge daily range, and that's why we love trading. The daily ranges of 300 to 500 pips are not uncommon to the average small day. Is probably around 160 pips. So gold is very volatile, and gold can easily swing 80 to 100 pips within a minute. And we have seen that. Large reversals are common. Unlike other commodities, the international gold market is a globe spanning market with continuous 24-hour operations. Thus, investors can trade in gold around the world market at any time they want to. So 4 ways to trade gold. So there's 4 different ways that people trade gold. There's a physical gold. This is considered an old method when discussing how to trade gold. Some cultures, particularly in Asia, still acquire gold physically. They believe it is a metal that never loses value and its price always appreciates. ETFs. ETF is exchange traded funds, is a fund that consists of one asset. In this particular case, of course, that one asset is gold. Gold ETF is a type of derivative contract that is backed by gold and reacts as an individual stock. Similarly, like the CFDs, that's what we're going to talk about. When you buy EFTs, you don't own the gold physically. Futures. Futures are contracts set between a buyer and a seller, which puts a predefined date in the future where the buyer purchases the gold based on the price agreed on to the set date. CME is the largest exchange that enables you to find gold futures for speculatory or even hedging purposes. So this is what we do. It's called CFDs. This stands for contract for difference, which is the most common method used when both trading gold and learning how to trade gold. So a CFD gives you the opportunity to trade gold based on the rising and falling of the price, using leverage to magnify your profits. It's worth noting that this means you should be careful because leverage can result in incurring significant losses on your account. And if we look over to the right, those are the 4 ways to trade gold. So let's go over just a simplified analysis. Like if you don't know anything about trading, you don't know how to use the bounce strategy or anything like that, what would you do to trade gold? Well, there's a very simple way to trade gold. And so it's called targeting previous highs and lows. So because XAU USD tends to trade in a range, one of the easiest strategies is to identify buy or sell opportunities within the previous highs and lows for the trading pair. Traders can open a position on gold when it's trending up, for example, and target a previous high as their sell price, or vice versa. Because gold is relatively stable asset, it's likely to reach these previous highs or lows over time. Note that this isn't a good strategy for day trading because it can take time for these targets to be hit. And range-bound strategies typically don't offer quick profits opportunities like momentum strategies do. That's what we're doing, momentum strategies, the MACD and the stochastic RSI. Still is relatively low-risk strategy designed to generate some profits of reliability, XAU USD price movement. And so what you could do is you can set it how? Using the Bollinger Bands. You know, Bollinger Bands XAU USD indicator uses a standard deviation of 2, which will enclose 95% of all good price action. Only 5% of chart gold price action will be outside the 3 XAU Bollinger Bands. So it'll either be outside on the top of it or outside on the bottom of it. This is why XAU traders open or close gold trades when gold price hits one of the outer Bollinger Bands. And that's what we teach here with, you know, the dot with this Bollinger Band trading. When it hits the top of the Bollinger Band, you're going to sell. Then you're going to take it going down. And then you're going to sell when it hits the bottom of the Bollinger Band. Now, me, what I do is a little different. I only go one way or the other. I had a great friend that traded with me. It was my right-hand man named Max. And he had this strategy called the Hungry Hippo, where he would trade at the bottom and at the top. And I don't trade like that. What I do is, like today, gold was in a downtrend for the day. So all I'm going to do is trade going down. So I'll wait for it to go up and then take it down. And what happens is you'll win more of the time when you just pick one way or the other if it's in a trend. Now, if it's in consolidation, then we could trade both ways. But usually, you know, it wants to be in a trend. Trades always want to be in a trend. It's unusual for them to be consolidated for more than 3 hours. So this is my personal information. If you want to check out some stuff, follow me on Instagram. Or Facebook, we got our own group called Forex Training Education and Tools. Go ahead and add yourself to that. There's other people on there just talking about trying to build it up really big and then be able to basically guide people on that too. We're in the building stage of this right here. And you guys, let's win together. Hopefully you guys got a lot of great information on gold and you guys learned on why we picked gold to be our #1 traded asset here right now on the live future stream. Remember, we trade gold, Bitcoin, and Forex.